Welcome to the Deep Dive. Today, we're taking a shortcut to being well-informed as we unpack a fascinating stack of recent market developments. These aren't just headlines. They're really the underlying currents shaping our financial world. We're seeing significant policy changes, major corporate moves, and, the ripple effects of global events.
Absolutely.
Our mission, as always, is to navigate these currents with you, extracting the most important nuggets of knowledge and insight. So let's unpack this.
Indeed. The market landscape is, it's constantly shifting. And what we're seeing in these recent developments offers a powerful lens, really, into both immediate movements and the broader long-term trends.
Yeah.
I'll go through each one, try to connect the dots and help you understand not just what's happening, but why it truly matters for the wider economic narrative.
Okay, sounds good. First up, then, a highly anticipated event. This could have pretty significant implications for businesses, consumers across India.
Right.
The 56th GST Council meeting. It's been 6 months since the last one. There's a lot on the table for this early July gathering, especially around rate rationalization and sector-specific relief.
Right.
What's the big highlight here from your perspective?
Well, what's truly impactful, I think, is the proposed big move to extend zero-rated status to intermediaries.
Intermediaries. Okay, what does that mean exactly?
So, to put it simply, these are services like IT, business process outsourcing, financial advisory.
Right.
Basically, services that facilitate trade and earn foreign exchange for India.
Got it.
Currently, even though they bring in valuable foreign currency, these services face an 18% GST burden.
Right.
The proposal is to omit Section 13(8) of the IGST Act. That's a specific rule in the GST law. Doing that would shift the place of supply for these services to where the recipient is based.
So if the client's abroad.
Exactly. If you're an intermediary in India serving a client abroad, that service becomes an export, taxed at 0%.
Okay, that's huge.
It is. This change aims to resolve these pending tax matters worth thousands of crores. We're talking tens of billions of rupees in unsettled claims. And crucially, it would align Indian taxation with global standards.
Making India more competitive, presumably.
Precisely. More competitive as a hub for service exports. It's a really significant step towards harmonizing our tax regime with international norms.
And speaking of rates, it sounds like rate rationalization is finally getting some serious traction.
Mm-hmm.
Reports suggest a near consensus to eliminate the 12% GST slab entirely, moving those items either down to 5% or up to 18%.
Yes, that's the talk.
This could also streamline things for sectors like footwear, fertilizers, textiles, EVs, sectors that have been grappling with these inverted duty structures. Can you maybe break that down for us?
Certainly. An inverted duty structure basically happens when the tax on a company's raw materials, their inputs, is higher than the tax on the finished product they sell. So take a footwear manufacturer. Maybe they pay 18% GST on leather, but they only charge 5% GST on the shoes. They end up with a big buildup of unutilized input tax credit. It's essentially blocked capital.
Which increases their costs.
Exactly. Increases costs and ultimately the price for you, the consumer. So by getting rid of the 12% slab and shifting items, the council hopes to reduce these situations, simplify compliance, and just provide a clearer tax framework.
And the fact they can even consider this now.
Right. That speaks volumes. The fact that the council feels it can consider these broader structural changes is really a testament to the stability we're seeing from rising GST collections. It gives them the fiscal breathing room, to make these kinds of reforms.
Makes sense. Another key discussion point that affects government revenues, state finances too, is the GST compensation cess. That's set to expire in March 2026, right? What's the expectation there?
Yes, that deadline is approaching. The compensation cess was brought in to, compensate states for any revenue shortfall after GST first came in. With it ending in 2026, a group of ministers is due to report by June 30, 2025, with suggestions. These seem to range quite widely.
Such as?
Well, from replacing it with a new health and clean energy cess, which would be a big step, needing a constitutional amendment, to simply merging it into the existing GST rates for items that currently attract the cess.
That decision feels pretty critical.
It is. It'll determine how state revenues are managed after 2026 and could really impact future government spending, especially on things like healthcare and green initiatives.
Okay, moving to some specific industry concerns the council might tackle. The food and beverage sector, they're hoping for relief on delivery service taxes.
That's right. Authorities have been seeking 18% GST, arguing it's a separate service, while the companies have been charging 5%, saying it's part of the food supply. This issue got deferred before, So the industry really wants clarity now.
And the ride-hailing industry, too, they're looking for clarity because of conflicting rulings.
Yes, exactly. Conflicting GST advance rulings, particularly around GST for e-commerce operators, using a software as a service model. One ruling apparently exempted an operator, others were told to comply. It's causing confusion.
To the point where a high court stepped in.
Correct. The Karnataka High Court actually asked the CBIC, that's the Central Board of Indirect Taxes and Customs, for clarity. It really highlights the need for a uniform, clear stance nationwide.
It really shows how the council has to navigate these quite specific, nuanced situations, like the insurance sector, for instance. They're hoping for significant relief.
Yes, there's speculation about a full GST exemption on term life insurance and also health insurance for senior citizens to make it more affordable.
And maybe lower rates, too?
Possibly. Reducing the rate from 18% down to maybe 12% or even 5% for health insurance up to, say, 5 lakh rupees. That's 500,000 rupees.
But the industry seems a bit wary. Why is that? An exemption sounds good.
Well, that's a great question because it really gets to the complexity of tax policy, doesn't it? Finding that right balance. While an exemption or lower rate sounds good for consumers on the surface, the industry is conscious about a blanket exemption or a 5% rate without input tax credit.
Because if they can't claim credit for the GST they paid on their input.
Precisely. Like services from consultants, IT systems, whatever it might be. If they can't claim that credit, those costs just get passed on to the consumer anyway in the premium.
So it could actually make it more expensive, defeating the purpose.
It could, potentially.
Yeah.
It highlights that delicate balance. The insurance regulator, IRDAI, has submitted its comments, so their input will be crucial. This whole GST discussion just shows how deeply tax policy touches every single sector.
Absolutely. Okay, so with these significant policy gears shifting, let's turn our attention to the corporate world, where these shifts play out. Starting with some major deals and market debuts. Hart Heavy Electricals Limited, BHEL, they're in the spotlight, bagged a massive rupees 6,500 crore order from Adani Power. 6 thermal units. This isn't just a big number, though, is it? It tells a story.
It absolutely does. This order is significant, yes, for its size, but also because it powerfully reinforces DHEL's really robust performance in fiscal year 2025.
And a good year.
An incredible year. Recorded their highest ever order inflows, rupees 92,534 crore. Alongside impressive revenue growth, 19% year-on-year, hitting rupees 27,350 crore.
Wow.
So this new order just demonstrates their continued leadership in the power sector. They secured over 81,000 crore in power sector orders alone. But it also shows their diversified presence.
Right. They do more than just power.
Exactly. Over 11,000 crore from the industrial segment, transportation, defense, process industries. BHEL's resurgence signals a broader strengthening, I think, of India's domestic manufacturing and energy infrastructure. It aligns with national development goals and signals strong momentum going into fiscal 26.
Okay, transitioning from established players to market debuts. The HDB Financial Services IPO, that just wrapped up.
Yes, and very successfully.
Impressive numbers, right? 16.69 times subscription. Largest IPO ever by an NBFC in India.
That's correct. It attracted really strong investor interest across the board. Qualified institutional buyers, the QIBs, they led the charge, booking their portion over 55 times.
That's huge demand. It even surpassed Zomato's IPO from 2021 in subscription terms for $1 billion issue.
It did. And this strong showing for HDFC Bank's subsidiary, which aimed to raise rupees 12,500 crore, it indicates significant market confidence.
Analysts were positive?
Largely, yes.
Yeah.
Recommended subscribe ratings. They pointed to HDB Financial's highly diversified product portfolio, across enterprise, asset, consumer finance. Those make up pretty balanced chunks of its loan book.
And their credit rating?
Strong. AAA stable from CRISIL and CARE. That's the highest for an NBFC in India. Signifies really exceptional financial health.
And the money raised, where's that going?
It's earmarked to augment the company's Tier I capital base. Basically, it's core capital. That's crucial for future lending, a measure of financial strength, ability to absorb losses. Boosting it directly enhances their capacity for future growth.
So a strong vote of confidence in the NBFC space, then.
Definitely. A key driver of economic growth.
Okay, staying in the banking sector, ICICI Bank. They recently approved increasing their stake in their asset management arm, ICICI Prudential Asset Management Company, by an additional 2%. What's the strategic thinking here?
The crucial aspect here is it seems primarily strategic for ICICI Bank to maintain its majority shareholding.
Oh, I know.
Particularly thinking about future stock-based compensation programs. ICICI Bank currently holds 51% in the joint venture. Prudential PLC has the other 49%. By increasing their stake slightly, they ensure they don't get diluted below that majority control if they issue more shares later for employee compensation.
Proactive planning.
Exactly. A proactive approach to managing their JV interests. And it comes alongside their board-approving amendments to give voting rights to their ADR holders, subject to RBI approval.
ADRs, American Depository Receipts.
Yes, allows U.S. investors to buy shares. Giving them voting rights empowers those global investors in governance matters.
Interesting. Now let's talk about IDBI Bank. Its stock has rallied significantly. What's driving that? Strong performance, potential disinvestment buzz.
It's a combination, yes. What's really fascinating here is IDBI Bank's journey. It was, once quite burdened by bad loans.
Right, I remember that.
But it has truly cleaned up its books, showing a strong return on assets, 1.98% in FY25, significant recoveries from stressed assets, low credit costs, really turned things around.
So what makes it attractive to potential buyers? Emirates NBD is mentioned as a top contender.
Beyond the healthy financials, the real attraction is its massive deposit base, over rupees 300,000 crore as of March 2025, plus a loan book over 200,000 crore with a big retail presence around 70%.
So a huge, stable funding source and customer base.
Exactly. That's incredibly valuable. Emirates NBD, the Dubai-based bank, has even received RBI's in-principle nod to set up a wholly owned subsidiary in India. Signals serious interest.
Is the potential deal already priced in?
Well, the current valuation, trading at about 1.5 times its estimated FY27 book value, suggests some of it is priced in. But a successful disinvestment could still lead to further value creation for minority shareholders.
And there's the NSDL IPO catalyst, too?
Yes, IDBI holds a 26% stake in NSDL and plans to offload 15%. That's a near-term potential positive. IDBI's story is really a prime example of a public sector bank turnaround, making it a hot target.
Okay, another major corporate move, JSW Group. Reportedly in talks with global lenders to raise about rupees 4,000 crore. This is to partly fund its acquisition of Akzo Nobel N.V.'s India business, a deal around $1.6 billion.
That's right. And this exemplifies a growing and quite fascinating trend in India,
Which is
the increasing role of private credit funds and global lenders in acquisition financing. Historically, big acquisitions relied heavily on traditional banks. Now we're seeing more diverse funding sources.
So foreign banks are involved here?
Expected to be, yes. Banks like Barclays, MUFG, Standard Chartered are tipped to arrange the debt, denominated in rupees. JSW is also engaged with international private credit funds. It shows a maturing, deepening corporate finance market here.
And a potential bond deal, too.
Yes, a rupee bond deal, if it happens, would be a boost for India's booming local debt market. Issuance is already up over 28% year-to-date, reaching 6.5 trillion rupees.
So this debt could be structured in different ways.
Potentially, yes.
Yeah.
Multiple tranches, levels, maybe a tenor up to 3 years. It really highlights the increasing sophistication and global integration of India's corporate finance scene.
Okay, switching to the pharmaceutical front, a couple of interesting developments. Torrent Pharma reviving its bid for KKR's stake in JB Chemicals and Pharmaceuticals, or JB Pharma.
Yes, that's back on the table, it seems. KKR's 47.84% stake is valued at roughly rupees 13,400 crore. It's a significant potential transaction.
This comes after earlier talks fell through.
Correct. Fell through, apparently due to valuation disagreements, which just shows how complex these high-stakes deals can be. KKR bought into JB Pharma back in 2020.
And JB Pharma itself is performing well.
Quite well. 12% revenue growth in FY25, hitting nearly 4,000 crore rupees. That actually outperformed the broader Indian pharma market's 8% growth. Their EBITDA and profit after tax also saw double-digit growth.
If the deal happens, there'd be an open offer.
Yes, mandated by regulations. An open offer for up to 26% of the stake held by public shareholders, giving them an exit option. It points towards ongoing consolidation in India's pharma sector.
Also in pharma, the Mounjaro KwikPen by Eli Lilly just got approval from India's drug regulator. This is for type 2 diabetes and obesity, a once-a-week injection.
Yes, in a pre-filled pen format. This approval is quite significant, especially following Novo Nordisk's recent launch of Wegovy. It really intensifies competition in this high-growth GLP-1 receptor agonist space.
How does Mounjaro work differently?
It has a dual-action mechanism. Activates both GIP and GLP-1 receptors. Simply put, these compounds help regulate blood sugar, reduce appetite, promote weight loss. So it offers benefits for both type 2 diabetes and chronic weight management.
And the KwikPen format, that's about convenience.
Absolutely. 6-dose strengths, designed for easy self-administration. That's crucial for patients, especially in India, with over 100 million people with diabetes and nearly as many dealing with obesity.
So more advanced options becoming available.
Exactly. It signals a new era in chronic disease management here. More convenient, effective treatments, creating a more competitive market, which should ultimately benefit patients.
Now let's talk Indian Bank. Shares jumped recently. Reports suggest a decision on the next CEO is getting close.
Yes, that seems to be the story. The rally, shares surged over 5%. It reflects renewed optimism about leadership stability.
They're looking at candidates now.
The board is, yes, evaluating 3 names apparently. Rajiv Anand from Axis Bank, Anup Saha from Bajaj Finance, and Rahul Shukla from HDFC Bank. Names are expected to go to the RBI soon for approval.
The RBI had set a deadline.
Yes, instructed the board to submit a panel by June 30. This leadership change is crucial for the bank.
They've had some issues recently.
They have. Scrutiny after some financial and regulatory setbacks in the March quarter, an accounting lapse, erroneously recorded interest income, plus SEBI action against former execs for alleged insider trading.
So the market's responding well to potential stability.
Clearly, a clear leadership path is vital for investor confidence in any major bank.
Okay, and finally for this corporate segment, Geo Financial Services. Shares hit a 6-month high.
They did.
Following news that SEBI granted its joint venture, Geo BlackRock Broking, a license to act as a stockbroker and clearing member.
Yes, and this is a truly key development for Geo Financial.
Why so significant?
Well, along with earlier approvals they got for asset management and investment advisory, this broking license means the Geo BlackRock JV can now offer really holistic investment solutions, covering a much wider spectrum of financial needs for Indian investors.
So a one-stop shop, potentially.
That seems to be the goal. As their MD and CEO, Hitesh Tathia, put it, it adds another dimension to their strategy of democratizing investments in India, using easily accessible digital-first solutions.
And their financials look okay.
Seems so. A healthy pre-provisioning operating profit of nearly 1,600 crore rupees in FY25, plus significant equity investments in group entities. It signals a really strong strategic push to expand their market presence and potentially disrupt the financial services landscape here, leveraging their huge digital ecosystem.
Okay, quite a lot happening on the corporate front. Let's shift gears now from boardrooms to the broader global stage. Let's look at the fascinating gold market dynamics. On June 26, spot gold was trading between, $3,310 and $3,350, caught between cross currents. Less safe haven demand because of the Iran-Israel ceasefire, but buying pressure from a weaker U.S. dollar.
That's a good summary of the push and pull. If we connect this to the bigger picture, look at the mixed U.S. economic data that came out recently.
Like the trade deficit and GDP revision.
Exactly. A wider advanced trade deficit and that downward revision of Q1 GDP, it actually fell to negative 0.5%. That's boosted bets for Fed rate cuts starting in September. Markets are now pricing in more than 2 cuts this year.
And there's speculation about the Fed share, too.
Yes, speculation that President Trump might announce a replacement for Jerome Powell as early as September. All this contributes to a weaker U.S. dollar. The dollar index slumped to its lowest since early 2022 and falling U.S. yields.
So it's a complex mix driving gold.
It really is. Economic data suggesting a slowdown, shifting monetary policy expectations, geopolitical shifts, political uncertainty around the Fed. Gold's movement reflects this complex dance. It's a key indicator of broader market sentiment right now.
And speaking of global dynamics, those India-U.S. trade deal negotiations, they seem delicately poised. Less than 2 weeks before Trump's reciprocal tariffs are set to kick in on July 9th.
That deadline is looming, yes. India seems keen for a mini deal, but is also wary of being rushed into something that disproportionately benefits the U.S.
Especially on market access for dairy and farm goods.
Precisely. The crucial thing here is, for India, this isn't just about commerce. It's about livelihoods. A huge chunk of the population, 45%, depends on agriculture.
So India's offered some concessions, but is holding firm elsewhere.
That's the picture. Concessions offered on things like almonds, pistachios, walnuts, even limited ones on apples and cars. But the U.S. is pushing for more, wanting greater access for its farm and dairy products, including genetically modified crops.
And India's position.
Firm on protecting these sensitive sectors, while at the same time seeking exemptions from U.S. tariffs, both the sectoral ones on steel and aluminum and those reciprocal tariffs.
What's interesting is India doesn't seem desperate for a deal at any cost.
Exactly, especially since other major economies also face steep American tariffs. It suggests New Delhi is aiming for a genuine win-win outcome, not just accepting unfavorable terms.
And Trump might extend the pause anyway?
There's speculation about that too, given the U.S. hasn't actually finalized substantial trade deals with most nations yet. These talks really highlight India's assertive stance now, protecting domestic interests while navigating these complex global trade relations. It's a balancing act.
Okay, bringing it back home then. Indian equities. They've responded positively to these broader shifts, rising for 4 straight days as of June 27th.
Yes, a solid run. Both the Nifty 50 and Sensex saw gains over 2% for that week.
What's driving this optimism here?
His strong performance, which also included the broader mid-cap and small-cap markets, seems largely down to a few factors. Easing Middle East tensions reduced geopolitical risk. Falling crude oil price is always a big positive for India as a major importer.
And a positive handover from Wall Street.
Yes, boosting global sentiment. The market here seems clearly optimistic about the potential extension of that U.S. tariff suspension, and also the growing expectations of faster U.S. rate cuts. More global liquidity generally helps markets like ours.
So the trend looks positive.
On June 27th, Nifty gained 0.34% to close at 25,635, Sensex up 0.36% to 84,058. Oil marketing companies did well due to falling crude. Real estate IT saw some profit booking. The trend suggests continued upward momentum, maybe a gradual climb towards 25,800 for the Nifty.
Suggesting a certain investment approach.
Well, it might make a buy-on-dip strategy seem appropriate for investors looking to enter. The resilience of Indian equities, even with global uncertainties, really underscores growing confidence in India's domestic growth story and its ability to absorb external shocks.
So quite a landscape we've covered. What does this all mean for you, our listener? We've touched on everything from specific tax reforms, major corporate acquisitions, to that intricate dance of global geopolitics and its impact on commodities and stocks. It's really a snapshot of a dynamic, interconnected world, isn't it? Showing how seemingly separate events all influence each other.
It really is. And this raises an important question perhaps for you to consider. As these market developments continue to unfold, how might they influence your understanding of the larger economic narrative playing out around us?
Yeah, how do these pieces fit together?
Exactly. Think about how this push for tax harmonization, these strategic corporate moves, the nuanced global trade talks, how they reflect underlying shifts in economic power and policy priorities, and maybe track how they keep evolving in the coming days and weeks. Keep exploring how these individual pieces connect to form that bigger picture.
Sound advice. Before we go, a very important note for everyone listening. We are not SEBI-registered financial advisors.
That's crucial.
If you are considering making any investment decisions based on anything you've heard, please consult a certified financial advisor first.
Definitely seek professional advice.
Thank you for joining us for this deep dive. Until next time, stay curious and keep learning.